What if the most important innovation in decentralized finance is not happening on Ethereum? What if it is not on Solana, not on Arbitrum, and not on any of the names you already know? What if the project that could define the next wave of DeFi is something that most of the market has barely noticed until now? That protocol is Avantis. And after this breakdown, you will not look at DeFi infrastructure the same way again. Let us begin with the bigger picture. In 2025, the macro landscape has changed completely from the cycles of 2017 and 2021. Bitcoin and Ethereum ETFs are not just headlines. They are active, drawing billions in inflows every month. Central banks are cutting rates after years of restrictive policy. Liquidity is coming back into risk assets. But unlike the past, this liquidity is not flowing into meme coins or speculation alone. It is searching for real yield, structured products, and scalable blockchain infrastructure. Ethereum 2025 is not about cartoon JPEGs. It is about tokenized treasuries, real-world assets, and institutional adoption at scale. The shift is clear. Infrastructure is where the smart money is positioning. So where does Avantis fit into this picture? Avantis, or AVNT, is a DeFi protocol designed to bring advanced derivatives and structured finance on-chain. In simple terms, Avantis is trying to replicate the sophistication of traditional financial markets, futures, options, hedging products, but on decentralized rails. That alone makes it different. Most protocols in the 2020s tried to capture retail trading flows. Avantis is aiming directly at the institutional layer. But here is where it gets interesting. Avantis has been quietly gaining traction not because of hype, but because its model connects to what institutions actually want: exposure, hedging, and yield, all without depending on centralized intermediaries. Avantis is built with Ethereum compatibility at its core. But unlike most Ethereum clones, it has focused on performance that rivals Layer 2 ecosystems. It integrates liquidity pools with advanced risk engines, allowing for derivatives products that traditional DeFi platforms could never sustain. Think of it this way. While Ethereum 2025 is scaling through rollups, Avantis is positioning itself as the specialized platform for structured on-chain finance. And in a world where the Ethereum ETF has already signaled that institutions are ready, protocols like Avantis stand to benefit from second-order adoption. The market may have missed one key detail. Unlike the meme tokens of the past cycle, Avantis is prioritizing risk frameworks, collateral management, and liquidity partnerships. Researchers in the DeFi space have started to highlight Avantis as part of the emerging derivatives infrastructure category. And some funds are tracking it, not because of hype, but because the tokenomics and roadmap align with sustainable growth. If you value deep research like this, subscribe to Crypto Wayfarer. Because here's where things get serious. The Avantis token, AVNT, is not just a governance placeholder. It plays a role in liquidity provision, collateralization, and risk management across the platform. This is important. Many DeFi protocols rely only on governance as a utility. Avantis ties its token directly to cash flow and protocol incentives. Stakers of AVNT participate in fee distribution. Liquidity providers earn enhanced rewards. And governance holders can shape how derivatives markets evolve on-chain. That is a critical difference. Because in 2025, investors are not looking for empty governance. They are looking for exposure to real revenue streams in blockchain infrastructure. But here is the twist. The risks are very real. Avantis is still young. It has not yet proven itself under extreme market volatility. Liquidity depth remains thin compared to giants like Ethereum Layer 2 seconds or Solana DEXs. And regulators are circling around DeFi derivatives more than any other sector. The same features that make Avantis attractive to institutions could also make it a target for compliance challenges. This is not noise, this is reality. So any investor considering AVNT must weigh asymmetric upside against real execution risk. But this changes everything. The bull case for Avantis is straightforward. If decentralized derivatives become a core layer of blockchain infrastructure, Avantis is one of the first movers with an institutional lens. If tokenized treasuries and real-world assets flow into Ethereum 2025 ecosystems, they will require hedging, futures, and structured products. Avantis is positioning to be the infrastructure provider. And if smart money continues to rotate into DeFi infrastructure instead of speculative tokens, Avantis could emerge as one of the leaders. Now here is the bear case. The bear case argues that Avantis could be outcompeted by larger ecosystems like Ethereum rollups or Solana, which already have liquidity, brand recognition, and developer momentum. It also points to the complexity of derivatives, which often require deep liquidity and sophisticated participants, something most of DeFi still struggles to support. And finally, it notes that regulation could slow adoption, making Avantis a niche product rather than a foundational protocol. Both views matter, and both should be part of any grounded investor's framework. But the roadmap contains one feature almost no one is paying attention to. The roadmap ahead is ambitious. Avantis is expanding beyond simple derivatives. It is preparing structured vaults that combine yield strategies with hedging products. It is exploring collateralized lending products built on top of derivatives markets. It has signaled intentions to integrate real-world assets, allowing treasuries and commodities to be traded on-chain with hedging built in. Its governance has already approved funding for cross-chain expansion, including compatibility with Ethereum Layer 2 rollups. And there are early discussions around partnerships with treasury management platforms exploring blockchain infrastructure. The next 6 months could decide if Avantis becomes essential or forgotten. Community and governance are also worth watching. Unlike ghost chains, Avantis has been building a base of developers and active DAO participants. Recent proposals have included adjusting margin requirements, expanding supported collateral, and redesigning liquidity incentives. These are not cosmetic changes. They are real levers of financial engineering. Developer activity, while not comparable to Ethereum, has been steady, with consistent commits and feature rollouts. That matters because in crypto, abandoned repos and stagnant governance kill protocols faster than competition. Avantis is not showing signs of stagnation yet. So what is the grounded takeaway? Avantis is not guaranteed to be the next Ethereum 2025. It is not positioned as a replacement for Solana. But it is one of the few projects aiming at the institutional layer of DeFi derivatives, structured products, and hedging strategies. That makes it different from the thousands of copy-paste DeFi platforms that came before it. And that difference is exactly why it is suddenly trending in 2025. For investors, Avantis represents an asymmetric bet. If it fails, it will fade like many before it. But if it succeeds, it could become one of the backbones of institutional adoption in decentralized finance. Whether you are tracking Ethereum 2025, the rise of institutional adoption, or the next phase of blockchain infrastructure, Avantis is one project worth your attention. Stay sharp. Stay strategic. And keep wayfaring.